Howdy, everybody. Welcome to Liberty Call. Today is Friday, February 21st, 2025. Hope you're having a fantastical day out there in the interwebs. The sun finally decided to come back out here in Colorado. We got about half a foot of snow overnight. That was fun clearing from the driveway. And looks like we might be, things clearing off. I wish the low pressure center would disappear because my head still hurts. All right. Well, markets are getting hammered with the Dow down over 700 points as investor anxiety spikes. United Health is plunging 9.2% amid a DOJ investigation into its Medicare billing. While NVIDIA's rally faded after concerns over competition from China's DeepSeek AI. Economic data is sending mixed signals. Manufacturing is up, but services are lagging and consumer sentiment is weakening. Treasury yields are slipping as recession fears creep in. Meanwhile, Alibaba is rising on surprise investment from GameStop's Ryan Cohen, and Celsius is surging 30% after acquiring Alani Nu for $1.8 billion. So before we break all the news down and everything from the week, I need some help from you. If you give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell. All right, well, let's hop into today's markets. Dow Jones was down 1.69%, 748 points, closed at 43,428. S&P 500 down 1.73%, 105 points, closed at 6012. NASDAQ down 2.2%, 438 points, closed at 19,524. The VIX was up 16.6% today. It's at 1826. Canada down 1.44%, Brazil down 0.44%, and Mexico down 1.11%. Headed to Europe, Germany was down 0.23%, the UK down 0.04%, France up 0.39%, the Netherlands down 0.11%, Spain down 0.12%, Italy up 0.45%, Switzerland up 1% flat, and Portugal up 0.38%. Russian exchanges were split today. The MOEX down 0.31%, our TSI up 0.08%. And the overnight markets, the Nikkei in Japan was up 0.28%, Australia down 0.32%, New Zealand down 1.64%. In China, the Shanghai was up 0.85%, Shenzhen Component up 1.82%, China A50 up 0.79%, DJ Shanghai up 1.08%, Hang Seng up 3.99%, and the Taiwan weighted when it closed on the 20th was down 0.49%. All righty, so those are our markets for today. Let's bring up our weekly chart and see how everything did. So let's see here. All righty. Starting out with Friday. Where's the last mark? There it is. Looks like Dow Jones is going to be down for the week about 2.51%. The S&P 500. I missed it. There it is. All right. S&P 500 down 1.7%. The NASDAQ, let's see here, it's going to be down 2.46%. The Dow Utilities are going to be up 1.67%. And the Dow Transports going to be down 3.32%. So that's the biggest one of these indexes. So looks like most of them were down, 2.5 to or between 1.7 and 2.5%. Seems to be the trend right now. So let's go to the daily chart and take a look and see how things are shaping up so far this year. This is the beginning of the year right here. So we had a little bit of a downturn and then a big upswing heading into the inauguration. And since then, been fairly sideways. And except for the last 2 days, which have been some pretty big down days. But again, we'll see. Looking at the chart, let me put in I don't have any resistance lines here yet, simply because it hasn't really, we broke what would be this uptrend, and it's been sideways for the better part of 15 days, so 2 to 3 weeks, and but that's where the markets are there on the Dow. Let's look at the S&P, very similar, and the NASDAQ. Again, fairly sideways markets most of this year. So, all right, well, so those are our markets for the week. And let me get into our economic data, starting out with jobless claims. Initial claims came in at 219,000, forecast 215, previous number 214. Continuing jobless claims came in at 1.869 million, forecast was 1.87, so just under forecast. Previous number was 1.845. The National Association of Home Builders Housing Market Index came in at a 42. The forecast was a 46, previous number 47. Building permits came in at 1.483 million, forecast 1.46, so better than forecast. Previous number was 1.482, so been fairly steady here the last 4 months. Month over month, building permits grew a 0.1%. Previous number was a 0.7% contraction. Housing starts came in at 1.366 million, under the 1.39 forecast. Previous number was 1.515, so a bit of a pullback from the previous month. And on a month over month number, it contracted by 9.8%. Previous was a growth of 16.1. All right, the U.S. leading economic index month over month contracted at 0.3%. Forecast was 0.1% contraction. Previous number was 0.1% growth. And U.S. existing home sales came in at 4.08 million. Forecast was 4.13. Previous number was 4.29. And existing home sales month over month contracted at 4.9%. Previous was a 2.9% growth. And lastly, the U.S. Michigan Consumer Sentiment Index came in at 64.7. Forecast was 67.8. Previous number was a 71.1. All right. So that is all the data for the week. Let's jump into the market recap. S&P 500 falls as softer economic data weighs on sentiment. The S&P 500 dropped sharply on Friday, setting the index up for a weekly loss after weaker economic data raised concerns about the state of the economy. The latest data from S&P Global showed a slowdown in both manufacturing and services sectors. The composite PMI for the U.S. dropped to 50.4 in February from 52.7 in January, while the services PMI fell below the expansion threshold to 49.7 from 52.9. Adding to the concern, the University of Michigan's Consumer Sentiment Index also took a hit, falling to 64.7 from 71.1, missing economist forecasts. The decline signals waning consumer confidence, which could weigh on spending and overall economic activity. This earnings season is wrapping up, but key reports, including those from NVIDIA, are still on the horizon next week. So this week's data is Rivian dropped over 4% after forecasting a decline in vehicle deliveries for the year ahead, despite beating Q4 earnings estimates. However, analysts remain optimistic about Rivian's upcoming R2 all-electric SUV. Block Inc. tumbled 18% after reporting disappointing quarterly earnings as rising competition in the payments space pressured growth. And United Health Group plunged 8% following reports that the DOJ launched a civil fraud investigation into the company's Medicare billing practices. United Health pushed back, calling allegations misinformation. Celsius Holdings soared 27% after announcing the acquisition of Alani Nu, strengthening its presence in the energy drink market. The company also delivered better than expected quarterly earnings. Hims & Hers Health sank 23% after the FDA announced that the shortage of Novo Nordisk's weight loss and diabetes drugs was ending, raising concerns about future demand for Hims offerings. And with ongoing economic uncertainties and market volatility, investors remain cautious heading into the final stretch of the earnings season. All right, so some good, some bad. Take the both in there. You have the facts of life. The facts of life. All righty. Next up, we got some data here. January existing home sales. This comes to us via First Trust and Mr. Bryce Gill. All right. The U.S. housing market started 2025 on a weak note, with existing home sales falling in January after 3 months of gains. Sales have been stuck in a stop-and-go pattern since 2022, struggling to break above the 4.3 million annual pace ceiling. The latest report showed sales at a 4.08 million pace, significantly below the pre-pandemic level of 5.25 million and the 6.5 million peak seen during the COVID-era stimulus. Well, can't really take that into account since everybody was refinancing since rates were at zero. A major headwind remains rising mortgage rates. Excuse me, since the Federal Reserve began cutting rates in September of 24, 30-year fixed mortgage rates have climbed above 7%, keeping many buyers on the sidelines instead of spurring demand. However, home prices continue to rise, with the median existing home price up 4.8% from a year ago. The market is becoming increasingly divided. Sales of homes priced above a quarter million have climbed, with many categories seeing double-digit percentage increases. However, sales of lower priced homes continue to decline, leaving lower income buyers priced out. Many current homeowners are reluctant to sell due to mortgage lock-in, having secured ultra-low mortgage rates before 2022. This has contributed to the tight inventory levels, restricting supply and keeping prices from falling significantly. However, inventory has improved, rising 16.8% year over year, pushing the month's supply to 3.5, though still below the 5.0 level considered to be a balanced market. In labor news, initial jobless claims rose 5,000 to 219, while continuing claims increased to 1.869 million, signaling continued but slower job growth in February. The Philadelphia Fed Manufacturing Index dropped from 44.3 to 18.1, reflecting moderating factory sentiment, though still above recessionary levels. And the outlook, without significant rate relief, affordability challenges will likely keep existing home sales weak in the near term, while higher end properties remain in demand. All right. One more article here from Zero Hedge. The tariff risk isn't inflation. This was written by Lance Roberts of realinvestmentadvice.com. All right. With tariffs back in the spotlight under the Trump administration, investors are debating the potential risks. While inflation risks from tariffs may be overstated, the real threat lies in corporate profitability. The assumption that tariffs automatically increase inflation is flawed. Consumers today have more product choices, and when tariffs raise the price of certain goods, demand tends to shift to alternatives, limiting price hikes. Alternatively, tariff wars often lead to counter tariffs, dampening global demand, which can actually have a deflationary effect. Corporate profits soared post-pandemic, fueled by massive stimulus, supply chain disruptions, and lower borrowing costs. Businesses passed on higher costs to consumers with little resistance, keeping margins high. However, the economic growth is slowing and inflation easing. Companies no longer can pass on costs as easily. This is where tariffs become a problem. Companies must absorb higher input costs unless demand remains strong. If tariffs increase costs on imports and retaliatory tariffs hurt exports, corporate margins will suffer. 41% of S&P 500 revenues come from international markets, meaning trade slowdowns in Europe and China could significantly hurt earnings. With corporate profit margins at risk, investors should consider sector rotation. Defensive industries like utilities, healthcare, and consumer staples are more resilient to trade disruptions. Margin analysis focus on companies with strong pricing power and efficient cost management. Currency risk, a strong dollar makes U.S. exports less competitive, further impacting profits. And long-term perspective, while tariffs create uncertainty, sticking to long-term fundamentals is key. With profit margins historically high, raising tariffs and slow demand or global demand, markets risks may be growing. A more cautious investment approach could pay off later in 2025. All right. Well, that is everything that I was going to cover for today. So if anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. Give me a buzz. I'd be happy to help. All right. Well, I hope everyone out there has a wonderful weekend, and I'll talk to everyone again next time. Adios.